I think we've had three very good sessions so far. I thought Mr. Weidmann's speech, Queen Maxima's speech, and the panel we've just had were really very insightful. So let me add a few thoughts building on what has been said. First, we all know something is changing in finance. There's a sense that the changes are going to accelerate, but we can't quite predict what is going to happen, as Mr. Weidmann said. We can't quite predict where finance will be 10 to 15 years from now. We know that there's some very exciting technologies, blockchain and others, but the technologies are going to evolve in an unpredictable way if history is any guide. Second, we can't quite predict which players are going to be up and which are going to be down. Will the new players, will the Davids unseat the Goliaths? Too early to say. But the reason why I think we are all excited and enthused by the use of technology in finance does not have to do with this competition between technologies or competition between players. The reason why we are all enthused in a new way about this is, in fact, inclusion. It's a new and profound phase in what was just mentioned as the democratization of finance. And I think technology now allows us to reach out to people and to transform the value that finance delivers to ordinary businesses and individuals in a new way. And that's the profound change. It's really inclusion. As a matter of scale, the biggest dimension of this is simply including people in developing countries who are currently without access to even basic banking and payment services. So that point has been extremely well made by Queen Maxima and Mr. Weidmann. 2 billion people, young populations with a good part of their lives ahead of them. We have to do this, and it can be done. The initiatives being taken in some countries, India being a foremost example, the Aadhaar initiative, biometric identification, allows for a certain leapfrogging. This is not going to progress in the same linear, incremental fashion that we are used to. I think it allows for a certain leapfrogging. So as a matter of scale, I think that's the biggest issue in inclusion. The SME issue is also fundamental. I think despite all the financialization of our economies, even in the most advanced economies, SMEs don't get the best deal in finance. They don't easily have access to capital markets, particularly outside of the United States. And the way in which banking has evolved has also left a large number, a significant proportion of SMEs, particularly left them out of early stage financing, but it basically doesn't give them a good deal. Households, in developed countries included, I think are a neglected issue. They have access to finance. In fact, in some respects, they have a bit too much access to choice in finance. But are we giving ordinary households, ordinary savers, a good deal? And I think the answer is no. We thought that there was a democratization in finance over the last 20 years, with a growth in capital markets, mutual funds, unit trusts, the arrival of choice in savings, as countries moved away from defined benefit schemes to defined contribution schemes. Choice has not been all that it's cracked up to be. It has pushed risk to the individual in a way that individuals can't manage. And the behavioral biases in every society has led to individuals also making bad choices. So the risks and returns just haven't been in proportion. Too much risk, not enough return, too high an amount of fees going back to the financial institutions. So it's not a good deal. And something can be done about it. That's households. So if you think of the SME sector, if you think of the household sector, even in the advanced countries, and if you think, of course, about the unbanked population in developing countries, Basically, we have the opportunity to tilt finance back to favor the end user. And the majority of end users are small enterprises and ordinary households, not those who have access to private banking services. We've got to tilt finance back to the end user, and technology is a potentially powerful enabler. Now let me make a couple of points, though, that are not so intuitive. First, in this play between disruptors and incumbents, I think we're seeing that play evolving in a way which I view as actually constructive, but which is a little less breathtaking than originally imagined. There was a certain breathlessness when fintech arrived on the scene, when you had these Davids arriving on the scene with what were very good ideas and using technologies that were hitherto not used in finance. Most fintech players have not survived. If you look at it over the last 10, 15 years, most haven't survived. Those that have succeeded because they've had good ideas that have been adapted over time and have matured, have been acquired by incumbent players. And what we are seeing is, I think, in fact, a positive trend in finance now, which is really about collaboration between the Davids and the Goliaths, either through acquisition or through partnership. And you're seeing many good examples of this, where the entrepreneurial spirit and ideas of fintech startups are being used to add value to the traditional financial incumbents. Why has it turned out this way? I think it goes to the heart of something which Mr. Weidman said. Trust is at the core, not just of central banking, but banking. In fact, trust is at the core of finance. And because of that, it's been very difficult for new players in this area of the digital economy, finance, to acquire scale. It's been very difficult for them to acquire customers. People are willing to hop onto new payment platforms, but to shift your wallet to a new institution, non-bank, may not be regulated, untested, most people are cautious. So acquiring customers has been more expensive, and it takes longer than anticipated. But the whole model required scale, because the whole idea of charging razor-thin margins and trying to provide a better deal to the customer required scale, otherwise the business model doesn't exist. And the scale is now being provided by traditional incumbents, those with large customer bases coming out of their deposit base, and those that just earn trust by virtue of being regulated institutions. So I think we're seeing an interesting combination now of incumbent players, those that are now better regulated and have better risk management of their own, but who basically still have the trust of the public. They are lending their scale to the new players, and the new players are lending their ideas and their applications to the incumbent players. You see it in SME lending in a very interesting way. Some examples, many of the P2P platforms haven't survived. As Mr. Weidman says, the real test is when you go through a full credit cycle. And many of them were trying to build up scale in half a credit cycle. Lend as quickly as possible. If only it was so easy. Banks would do it. Why do banks not lend as quickly as possible? Because there is such a thing as creditworthiness. So that was the lesson from that first wave of P2P platforms. But now you're seeing people like, entities like OnDeck. OnDeck was a startup using data analytics and, in fact, tapping on a huge amount of data from public records, from e-commerce records, even from social records. Huge amount of data available in order to assess the creditworthiness of small borrowers, including SMEs, because the owner of the SME, the data on the owner of the SME is a very important indicator of the creditworthiness of the SME. So OnDeck, it couldn't acquire scale on its own, But BBVA lent it its customer base. BBVA referred small customers to OnDeck. And now JP Morgan Chase has come on board about a year ago as well. So very interesting example of how this teaming up of the Davids and the Goliaths is turning out to be a more workable and sustainable model. The second point, which is again not very intuitive, has to do with how we think about some of the new monopolies or seeming monopolies in this game. Delivering a low-margin service to a very large number of SMEs has been a very interesting phenomenon in China. Not just SMEs, but individual borrowers. Very interesting phenomenon in China and in some other places. But the logic of it is that it requires a very large customer base. And in the Chinese case, it came, in fact, from outside banking. It came from social media and e-commerce players moving into the lending game. But they're very large. And at first sight, a normal regulator would look with some suspicion at an industry where winner is taking all or winner is taking most. But think again about it. And I raise this as a question, not as an answer. Precisely because they have that scale and they're able to exploit network economies to the fullest, they are offering a deal to the small borrower and the individual that hasn't been offered before. Much smaller margins, much more better access. And here I'm talking about some developing countries where there was just no access before because the playing field was tilted in favor of large borrowers or state-owned borrowers. So can we design a framework of regulation that tolerates scale on the part of the provider, because that's what allows for network economics to work, in order to provide consumer surplus down the line, in order to provide the small borrower with a better deal. Normally, monopolies earn monopoly rent, and someone gets shafted down the line. But this is a different model. The people down the line, the small businesses and the individuals, are getting a better deal than before because there's someone who looks quite monopolistic at the top. How do we deal with this regulation-wise? I think some regulation is going to be required, but it's not our usual instincts that have to operate. We have to think hard and creatively about how we allow network economics to work in order to deliver consumer surplus down the line. So that's the second point I want to make. The third point I want to make, which is, I think, more intuitive and builds on what Queen Maxima said. When we think about financial inclusion in the developing world, it isn't just about payments and finance per se. That's extremely important, of course. Participating in the modern economy means you've got to be able to make payments in a way that customers not in the same village, not in the same town, have trust in. But it's at the heart of it also about social inclusion. Because without financial inclusion, there are huge problems of social inclusion, even in education and health, and just insuring yourself against basic life risks. Payment for fees in education means going quite some distance, parents having to go to the school in order to make a cash payment, and unfortunately, you have leakages. Schemes where governments try to subsidize girls' education or other schemes are often also, unfortunately, prone to leakages, basically robbery. So digital finance, by being able to pay through your mobile phone or being able to receive a grant from government in your mobile phone, through your mobile phone, is a way of reducing costs, saving time, keeping the girls in education, and it's really about social inclusion at the end of the day. And the interesting thing there is how some of the new players have been catalysts in social inclusion. And it's an international game. It's quite interesting. I'll give you an example. In education, for instance, which is an example I just gave, Pakistan. Some of the usual problems you find in a developing country landscape when a government wants to give transfers. And in fact, this is an example which I just mentioned. Girls' education, they wanted to support the parents because your fees may be low, but the cost of uniforms, books, and various other expenses are not so low. So the government gave a grant to every girl's family, but the money didn't always get to them. And the cost of dispersing the grant was itself larger sometimes than the amount of the grant. So who enters the picture? Telenor, telecoms company, working with Easy Paisa, a local entity. Not rocket science, but ensuring that that government stipend goes directly to the family through mobile money transfer. Another example, quite interesting, microinsurance. Most of the world is not insured against basic life accidents or risks. Accident insurance, life insurance, hospitalization insurance. And that's a very important part of social inclusion. Insurance is part of modern life because it distributes risks in a fairer way. But most of the world doesn't have insurance. A Swedish company called Bima, B-I-M-A, its whole business model, it's a not an insurance company, it's a fintech player. Its whole business model is to target the underserved populations in Africa, Asia, and Latin America. And they devised a proprietary back-end technology to deliver mobile insurance. And how it works is, people basically pay for their insurance through deduction or prepaid airtime credit. They've got mobile phones, getting airtime credit isn't so difficult, and they pay for the insurance by deducting from that. And they get a monthly reminder when they need to. Fintech player teamed up with conventional insurance providers to be able to deliver micro-insurance with some tailoring of the products to people who just want very basic insurance. Another very good example. But the nice thing about this new game is that it's full of surprises. Who would have expected a Swedish firm to be involved? Who would have expected Telenor to be involved in a government scheme to help girls' families? It's full of surprises. And if I can give you another surprise, which I really liked recently, we had a fintech festival in Singapore recently. It involved a competition, including an international competition, and there was a firm that won 2 awards. It was a Thai firm, a fintech subsidiary of a Thai bank called Kasikorn Bank. Not a very well-known bank, not a significant international bank. It's a subsidiary called Beacon. And they won 2 awards, and I must tell you, it was a highly competitive competition with some really good players. And what they did, they had a group of very talented individuals, is they thought that there is in the world about 285 million people who are blind. And normally when you think of fintech and technology, it's going to be a great enabler for those who are disabled or who don't have mobility. You don't have to find your way to a bank branch. You can stay at home, use the internet, use your mobile phone for a fair bit of your banking. But if you're blind, it's not so easy. So they've devised a technology that involved audio guidance and vibration. And each screen allows for just one task. It was intuitive, easy, and I'm making it sound very simple because I'm describing the friendly front-end user face, but the work at the back end was very clever. Good example. We weren't thinking about the problem. No one was thinking about the blind, but it's 285 million people. And here you have a group of people with technology skills teaming up with a bank to deliver mobile banking services in an intuitive, user-friendly way. Again, a different sort of surprise, because you wouldn't have expected it from a subsidiary of not a large bank in Thailand to come up with a winning award against competition from players in all the major financial centers. But they did. And that too is something democratizing. Innovation is being democratized in this new game. The surprises are coming out from everywhere. But let me end my presentation by talking about something which came up at the panel just now, which is really about the future of jobs in finance. It's going to be a challenge. You don't have to have very precise estimates, but we know that a significant number of back office jobs are going to disappear because the automation of settlement processes is a certainty. That's one thing I dare predict. And you're probably going to see a halving of the number of jobs at the back end of finance. Middle office too, I think under significant threat because big data technologies have tremendous potential. I don't have a feel for the numbers, but people say about 40% of the workforce is going to go within a decade. And I'm here talking about the developed markets. So that's a very significant loss of jobs. At the front end, it may be different. You have to remember that when ATMs were introduced, the traditional bank teller job was no longer required, but the number of people working in bank counters didn't shrink. In fact, it grew because they moved on to distribute other products and advise people on their own finances. But that's where I think we have to create new jobs and new skills at the front end. And what I mentioned earlier on about how that first phase of democratization of finance hasn't really delivered value for ordinary savers and households can change. It can change. We need more independent advisors in how you plan the finances for your life, and not people who are trying to sell products manufactured by their institutions, which is the old game. You manufacture products, you persuade people they need it, and you sell it to them. That game has to change. And it requires a different set of skills, in some respects a different set of values on the part of the financial institutions themselves. But skills are important. There's going to be a contraction of jobs in finance in the most advanced markets. I think in the emerging markets, finance is still a growing industry, including a growing number of jobs, because these are markets which are still underserved by finance. But there's a big adjustment coming in the advanced markets and in most of the developed financial centers. But there are very good jobs available still. And we've got to equip people with the skills of the future in finance. It is a subset of the larger challenge of equipping people with the skills of the future across the economy. And some of what was said earlier was highly relevant. It's going to require new modes of learning, a new time frame for learning, so it's not just front-loaded in the first 12 or 18 years of your schooling. It's about continuous learning through life, and it's going to require quite new skills which were not previously emphasized in finance. So if you think about the skills that are already in great shortage today, cloud computing skills, data scientists and data analysts, software developers who have what's called agile thinking, and the ability to make the most of APIs to give access to third-party providers. Cybersecurity experts, and that's a whole range. We are already in short supply in every major financial center. London, Singapore, New York, everywhere. There's a shortage of people. And we've got to develop them. We can't go back, we can't unwind things and go back to what university should have been or what polytechnic should have been, but it is now possible to provide an infrastructure and a new mode of learning that helps people who are in their 20s, 30s, 40s, and beyond to pick up the new skills of the future. And it's quite interesting because you have a new set of players now, besides the universities and established educational institutions. In Singapore, we now have General Assembly, Byte Academy, something called Financial Academy. New players, private sector players, offering short courses. Bite-sized learning is a very interesting new field. I was just visiting a factory in the outskirts of Stuttgart yesterday. A very successful Mittelstand player. And I was talking to the person who manages the factory. This is one of the Industry 4.0 factories. I was talking to him about how they keep upgrading the skills of workers who are, they're mature workers. The average age was past 35. average age around 40, and several were much older. And he told me what they very often do in the course of the week is to bring teams of people in for a short module. So I said, how short is it? He said, half an hour. And then immediately put it into practice. Because there's an old Chinese saying, but what you put into practice, you remember. And what you put into practice quickly stays in your mind much better. So it's a whole new field of learning across our economies, across a range of dimensions, but in finance too. I think we've got to experiment with investing in people's skills at different stages of their career. No matter what we do in the school years and the university years, polytechnic years, isn't going to be enough. It'll give you the right instincts, it'll give you the right foundations, but we've got to keep learning through life. And we take it very seriously in Singapore. It's in fact one of our most important initiatives when we talk about fintech. It's really about developing the skills for the future so that there will still be quality jobs in finance. You might not have the same absolute number of jobs, in fact probably not, but we do want quality jobs. And that too is part of inclusiveness. Thank you very much.